Have you ever stopped to think about what it actually takes to multiply an entire country's economy by 10? I mean, that's not just a small bump, that's a massive leap. Welcome back to The Explainer. Today, we're diving into a really fascinating economic dynamic unfolding over in Uganda. It turns out the primary engine for their massive national growth isn't just big corporations, it's actually women-owned businesses. It's this brilliant story about recognizing totally untapped potential and realizing that sometimes the absolute key to macroeconomic transformation is found right at the micro level, squarely in the hands of local entrepreneurs. Let's get into it. Here's our roadmap for today. We're going to cover the tenfold growth ambition, the scale ceiling, quality over quantity, the grow project delivery, and finally, measuring real impact. All right, section 1, the tenfold growth ambition. So Uganda has set this incredibly ambitious goal, a tenfold growth ambition. Just think about that math for a second. Multiplying the size of an economy by 10. This is a monumental macroeconomic target, and to actually pull it off, well, it absolutely requires a much larger base of private enterprises scaling up. You just can't achieve that kind of staggering growth without significantly stronger private sector participation. The government basically realized, hey, we need to move way more of our entrepreneurs from just participating in the economy to achieving meaningful commercial scale. And when you look at the broader economic landscape, it becomes super clear where that growth is actually going to come from. Women-owned enterprises aren't just operating on the fringes over there. They are already deeply embedded in Uganda's productive economy. We're talking about the critical sectors: agriculture, trade, manufacturing, and services. In both urban and rural markets, these women are the ones supporting household incomes, sustaining local supply chains, and, crucially, creating much-needed jobs. So expanding their productivity, that sits squarely at the center of the country's whole economic transformation agenda. Which brings us to section 2, the scale ceiling. Okay, so if women are already operating heavily in these sectors, you gotta ask, what on earth is stopping them from scaling up? Well, there's a stark contrast in the current landscape. On one hand, you've got businesses that are incredibly commercially active, right? They've got loyal customers, active trading relationships, clear-cut opportunities to expand. But on the other hand, they remain structurally limited. They are severely undercapitalized compared to the size of the opportunities sitting literally right in front of them. This bottleneck hits hardest when a business needs to, say, buy heavy equipment, drastically raise production, or fulfill massive orders. Plus, things like formalization, keeping solid financial records, having governance structures, official registration, that increasingly determines whether an enterprise can even get finance or win formal contracts at all. Without those structural foundations, totally viable businesses hit this concrete ceiling. They just get stuck. Moving on to section 3, quality over quantity. This brings us to a really critical realization about the fuel we're putting into this economic engine. It's not just about throwing money at a problem. It's about the kind of money. Why does the actual structure of the financing matter just as much as simply getting access to credit? Well, because simply handing out microloans or short-term cash isn't going to build factories. It's not going to buy heavy agricultural equipment, and it certainly won't allow a trader to build up their stock ahead of peak seasonal demand. Annette Kikonko, the chief retail banking officer at DFCU Bank, hits the nail on the head here. She points out that the capital has to actually match the specific return cycle and cash flow of the business for it to be a true productive investment. Think about it like this. If you take out a loan to buy a huge piece of manufacturing equipment, that machinery takes time to install, get running, and finally generate a return. If your loan demands repayment before that machine even churns out its first product, that financing is actually suffocating the business, not helping it. So quality financing has a massive, direct bearing on real-world business performance. All right, let's look at section 4, the Grow Project Delivery. Let's see how this plays out in reality through the Grow Project, which is a Government of Uganda initiative supported by the World Bank. To deliver this effectively, they're using participating financial institutions like DFCU Bank. And DFCU is bringing some serious, deep experience to the table here. Through their Women in Business program, which, by the way, launched way back in 2007, DFCU Bank has already supported over 85,000 women. That is a massive scale. And that track record, it matters immensely because a farmer, a processor, and a manufacturer all face completely different hurdles. DFCU provides the exact sector understanding and tested platform needed to actually deliver the Grow initiative effectively. On top of that, DSU operates 55 branches right across Uganda. This footprint is absolutely vital because the need for growth capital isn't just bottled up in the capital city of Kampala. By having teams spread across the regions, they tap into real local market intelligence. The branch teams understand regional business cycles, seasonal cash flows, and local supply chain pressures, meaning they can provide highly relevant growth capital and engage with the actual operating realities of these entrepreneurs, way beyond the major urban centers.
But hey, remember that scale ceiling we talked about a minute ago? Because capital only works if the business has the systems to actually manage it, DFCU goes way beyond just handing out loans. They pair their structured grow financing with some seriously essential capacity building programs. We're talking financial literacy, mentorship, business training, and market-oriented guidance. This holistic approach helps entrepreneurs keep better records, formalize their operations, and truly prepare for those much larger commercial opportunities. Basically, they are building a rock-solid foundation so the house can grow much, much taller.
And finally, Section 5, Measuring Real Impact. So how do we know if this whole integration of macro policy and micro lending is actually working, right? Well, the true measure of success isn't just tallying up how many loans got dispersed. It's looking at these specific performance indicators. Are we seeing actual revenue growth? Is profitability trending up? Has productive capacity and asset acquisition increased? And, crucially, are we seeing real job creation and formalization into larger markets? These are the measures that prove the financing is genuinely converting into enterprise expansion, which, of course, feeds right back into that tenfold national growth agenda.
And honestly, the early traction is undeniable. Already, over 1,600 women have benefited from Grow financing through DFCU. This absolutely confirms that there is a massive pent-up demand for affordable, well-structured growth capital among female entrepreneurs. The ultimate success here will be watching these thousands of businesses formalize, scale up, and visibly drive Uganda's private sector growth in the years to come. As we wrap up our explainer today, it's crystal clear that when women-owned businesses invest in equipment, expand their output, and break into larger markets, the entire nation benefits. It serves as a really powerful reminder that backing women entrepreneurs isn't just some feel-good social initiative. It is a rigorous, undeniable economic imperative. I'll leave you with this final provocative thought. If empowering women is the literal key to a tenfold national growth, can any economy, anywhere, afford to leave their potential untapped? Thanks for joining, and we'll see you next time.